Hello, this is Stephen Evans on the 9th of September 2020, and I'm going to run through a presentation on our simplified global portfolio. We're looking to make this as simple as possible, diversifying across all markets in the world. And then for our clients to stick with this objective for the medium to long term. So this is a simplified global portfolio, and the starting point is a chart of world equity valuations. And the United States is by far the largest stock market. The UK has fallen to just 5% of global markets. It used to be 10% 15 years ago. And China, in terms of the free floating stock market where international investors can participate, is now bigger than the UK stock market. And recently we heard that Apple at $2 trillion was valued at more than the whole of our top 100 FTSE companies. So we advise our clients to invest as global investors. So starting from this universe with no home bias, total objective investment in the whole world. So equity valuations across the world total some $70 trillion. There's also a very important fixed interest market, or bond market as it's called, with both government bonds, which are an important part of any portfolio, and corporate bonds. And these are what are called investment grade, which are the safest grade of corporate bonds, as opposed to junk bonds, which very high yield but very risky, and some emerging market bonds. So we include bonds to reduce the risk of the portfolio as an insurance policy, but it is the equities that give the long-term real growth. And this chart shows since 1990, so 30 years, how if you had invested in treasury bills the whole time with income reinvested, you would end up with £4 after 30 years. The World Equity Index, with dividends reinvested over 30 years, would give you a total accumulated value of £13. But we can see how smaller companies do give a higher return. Smaller companies have accumulated £22, and value companies have accumulated £19. Value companies are essentially cheap companies when measured against their net book value. So for various reasons, a company's share price might be trading at a low price. But if you can acquire those assets at a lower price, and those assets in due course perform according to market rates of return, then you will have you would have gained an added premium or benefit from doing that. So our strategy is to invest in the whole world share market, with a weighting towards these smaller companies and value companies, and also a weighting towards emerging markets, because it's also clear that emerging markets have outperformed the developed world stock markets. And this again shows that both UK, European, US, and emerging markets across all sectors of the world, in terms of size, US, for example, over that period, a long period of 90 years, small has given 11.94% per annum return, and whereas the larger companies have given 9.92. So there's a clear smaller company premium long term. Value, again, across the world, value companies, those that are priced relatively lower, have outperformed the stocks, the opposite, which are known as growth stocks. So the investors are investing in those stocks in order to achieve long-term growth, but they have to pay a higher price. Profitability is also a factor that's been identified, that clearly higher profitability companies tend to give a longer term return than low profitability companies. Why do we include bonds within a portfolio? In the last financial crisis, from October 2007 to March 2009, global equities fell by 37%, but investment grade bonds during that same 18-month period increased in value by 10% and treasuries by 14%. So these were seen as safe haven assets. And if you had already been holding them in your portfolio, then you've got the benefit of that move to safe haven assets at the time when shares were crashing down. So we have produced a simplified global portfolio, 38% fixed interest of bonds, 2% cash, 60% in shares across the world, using global funds provided by Dimensional or Vanguard, both of whom are global investment companies whose stated aim is to put the client first, to provide value for money, and where the ongoing fund costs are relatively low at 0.32% per annum, compared to an industry average of 0.75% per annum, with some funds charging 1.5% per annum. So good value funds, invest for the long term, stick to your objectives, and all the evidence shows that you would gain long-term advantage. And here we have an analysis of the proposed simplified portfolio, which shows that the exposure to the small and value factors are pretty close to our current portfolio, and close to the Dimensional World Equity Fund, which already includes small and value. This is a monthly report, which shows the overall returns over 1, 3, 5, and 10 years for our standard portfolios. For example, the 60-40 share to bond portfolio over 10 years to, in this case, it's to the 3rd of August, has given an annual return of 7% per annum. That's after fund costs, but before advisor fee or platform fee. But that's an average, the average return over 10 years. And if you'd gone into an all equity portfolio with our same structure of the models, that would have given 9% per annum, but you would have had a much more volatile and risky portfolio with more downs and ups along the way. By comparison, the FTSE All-Share Index has given 6% per annum over 10 years. The World Index, if you'd been invested in the world equity market, that gave 11.6% per annum over 10 years. Vanguard do produce a forecast of what they expect investment returns to be over the next 10 years. Based on performance data from the past 30, 50 years, but taking into account economic and political factors such as the current environment of low interest rates, very high government debt, uncertainty about the COVID crisis, etc. They include those factors in, or circumstances, as well as a analysis of data stretching back 50 years or more. And they're expecting that the 60/40 portfolio would achieve something like 4.6% per annum. So lower than in the past 10 years, but still positive, still above inflation, which they're expecting to be around about 1 to 1.5% per annum. If you went up to 100% equity, you get a higher expected return of 6.6% per annum, but with a greater level of variability in the outcome. So as you increase the equity content, you increase the volatility, the risk, and also the expected return. So that is a summary of our simplified investment strategy, and giving exposure to the 12,000 quoted companies across the world in the proportions that, based on the evidence, we feel that you would get that extra premium from a weighting in the smaller companies, in value companies, and in emerging markets. But the important thing is to stick to the long-term objectives throughout the downs and the ups in the markets. The likelihood is that you would get a real return over and above inflation. Thank you very much.